All right, guys, welcome back for another video. I know it's been quite a while since I uploaded a previous video. A lot of people are probably wondering what I've been doing. Still trading, just not publishing videos. But, it occurred to me that probably still people out there who are interested in my thoughts on the market. And there's definitely quite a lot to discuss. Big things are happening in the market. This is a really important time, and I feel like there really is a lot to discuss. I feel like the narrative in the market is really getting caught off guard, and there's a very large potential for a lot of people to get caught off sides in the next few months to 6 months to 9 months. In my opinion, there's going to be massive volatility, bigger than what we've already seen in both directions. So I'll get into that. The chart we're looking at right now is the S&P 500. But I've also got the Bitcoin chart, the dollar currency index, the TLT, long duration bond, and oil, which really are the 5 most important markets. So I'll be going through each of those in turn. But first, I just want to start with the S&P 500, which is the chart I'm looking at currently. So this is my price target on the S&P 500. I know this, seems outlandish to a lot of people. And it's understandable because of what the narrative was. The narrative was when the Fed raised interest rates that, the market's not going to go up until the Fed lowers interest rates. Well, the Fed's holding interest rates and the market's starting to go parabolic. And, the thing about parabolic markets is that they accelerate into the peak and they get steeper and steeper until they blow off. And it's almost like a law of nature. Like the more it goes parabolic, the steeper it'll get. And then, on the other hand, every parabolic blows off. Even Bitcoin, right? Now eventually, Bitcoin always reclaims the highs of a parabolic blow-off, but at the same time, every parabolic does blow off. So that's a very important thing to keep in mind. Most of my trading strategies involve trading around parabolas, because they're very predictable things that happen in the market, market psychology, market structure around those parabolas. And we have the opportunity to do that just on a very large scale here, if what I think is going to happen comes to pass. Now, there was this big, consolidation here. You can mark off this area here on the S&P 500. This high, came up here, and basically for a month or two, essentially the S&P 500 was in this range. You got this big down close candle going into the FOMC that was last month. And, a lot of people got bearish here. Now prices basically just ran for the highs after that. To me, that the way the market reacted to the psychology here tells you a lot about the current state of the market. As the market was rising, people were getting bullish, but they didn't have any conviction in their bullishness, because as soon as you saw this candle here, this down close candle, a lot of the sentiment flipped, and it was that this is the top and the market's going much lower. So I think what's happening now is, as the market's making new highs, I think that's starting to change. I think what happened here is, as as the S&P 500 broke new highs, what started to happen here, as you got this price action, was fund managers who were bearish before all-time highs, calling for lower lows. They saw the break of the all-time highs, but the market didn't pull back and give them a buying opportunity. And as I mentioned before, a lot of people started getting bearish here. I think when the all-time highs were broken, fund managers flipped cautiously bullish. But, they were looking for a deeper retracement, right? So something back into the all-time highs or into a 618 retracement. Point being, if you were bearish on the way up and then you see the all-time highs broken, you start flipping cautiously bullish. You don't want to buy the highs, right? A lot of people were you know, just looking for a deeper pullback than what they got. But now you have the highs taken out, and a lot of that capital on the sidelines is now they're just, the mindset has shifted to, we can't afford to wait for a pullback, right? We'll miss out. You're starting to see FOMO kick in, right? Cautious bullishness is flipping to FOMO. And that's how you know we're kind of getting to a late stage of this cycle. And, psychology just plays out the same way over and over. People flip bearish, they start chasing the market, and they start making money doing it because the market's going up, right? And then other people see their friends doing it, their neighbors doing it. Nothing will throw a trading plan out the window more than seeing your neighbor getting rich, right? It's just market psychology. It's never going to change. It's the same every single time. It just is what it is, Even if AI starts trading, they're managed by machines, and the capital is ultimately owned by people with human brain psychology. So I know it seems outlandish that the market could go to, S&P 500 could go to 700. Excuse me, SPY could go to 700. I believe the S&P would be 7,000. But we're talking about, from the current market price, a 31% increase. And that could happen in a matter of months. As this thing steepens. And, as that happens, you start to see the narrative change, right? When we were down here, you saw podcasts with people posting YouTube videos with flames in the background, flames in the background, flames in the background. All right, well, when we took out all-time highs, they took the flames down, but they're still bearish. When you start going parabolic, you'll see the narrative change, right? The narrative will flip from, all the bearish narratives you've been hearing for the last year or two. Those are going to disappear, and you'll start to hear bullish narratives, right? And not just bullish narratives in the short term, but the type of narrative where, like, this is the beginning of a multi-year bull cycle. And that will be the narrative that convinces people that it's okay to buy the top when the top does come in. So it's very important to be cautious about that. It's one of those things about psychology, like, people who think they're being disciplined with their capital right now, they're exposing themselves to the risk of, being out of the market while the market goes parabolic, and then being captivated by the siren song of the narrative that comes during that parabola. And it's very difficult to resist that, right? A lot of people will end up buying the parabola. I mean, it's just market psychology. I mean, you could shout this stuff from the rooftops all day, and it's not going to change anything. Anyway, so my big picture view is that, the market's starting to reach its final parabolic phase that will ultimately blow off. And I don't know when that will happen. I think it will happen before the end of this year. I'm pretty confident in saying that. I think we're entering the final stage of the melt up. And what does that mean? Well, that you could see a very, very steep decline. You could see a parabolic rise up to these levels, and then a bust or a breakdown back into the all-time highs from this level, or even further. And sort of the rationale behind that is the fact that the tightening that the Federal Reserve has been doing it has a lag effect, right? So as the Federal Reserve has been tightening rates, they're not taking into account fully the downstream effects that will have. And some of the effects don't show up for 6 to 10 months or 12 months. And I do think they've over-tightened. I think credit has tightened. I work in credit markets, and I've personally seen credit tightening. I work for a very large bank, but I won't name the name of the bank. But, things are tightening up. And, that's part of the reason why equities are rising right now, is the risk-adjusted return on equities is far greater than bonds right now in this current moment. Now that will change, and the moment that'll change is actually when the Federal Reserve starts lowering interest rates, which is paradoxically very contrary to what the narrative is out there, which is that a lot of people, now they may change it, but if you went back a year, a lot of people would say, I'm going to wait until the Federal Reserve lowers interest rates to buy stocks, buy equities. And that's not the right way to look at it, because once the Federal Reserve actually starts lowering interest rates, then the risk-adjusted return of equities being superior that I just talked about shifts towards bonds. So when the Federal Reserve starts lowering interest rates, bonds start to have a better risk-adjusted return than equities. So actually that's probably around the time. Might not happen exactly then, but the stock market will probably top out around the time that the Federal Reserve starts lowering interest rates, precisely because the risk-adjusted return of bonds has now shifted more favorably, and capital is leaving the equity market and going into the bond market. That's the only reason, literally the only reason. Anyway, I don't have a crystal ball. I don't know exactly when that will happen, but if I had to predict, I would predict, early Q4, sometime in Q4. It could happen in Q3, but I think in like October, November, December, by end of year. Again, I don't have a crystal ball, but that's kind of what I'm looking for. Could it spill over into the next year? Of course. Could it happen earlier? Of course. But this is I'm just sharing my mental model that I'm working with currently. Now, if that were to happen, if you were to have a bust in interest rates, now, I should pull up the 30-year yield here so you can see how the 30-year yield trades contrary to the underlying price of the long duration bond. But let me pull that up real quick. So what I'm predicting, is ultimately for long dated bonds to return to start reaching for some of the historic lows. Now, of course, it won't all happen at once, right? But I think you've seen a change in trend in yields, right? So for the last couple of years, you've seen yields rising, basically since the Fed started, since the pandemic actually was when it bottomed out. But, yields have topped out around 5%. You can look across the yield curve. The Fed is holding interest rates at 5.3% at their prime rate, their overnight rate. But you can look across the yield curve. Actually, TradingView is so nice to have the yield curve right down here. But you can see that the yield curve is inverted. The short end of the curve is higher than the long end, which lends to my point that this isn't the beginning of a multi-year bull cycle, right? What the bond market is telling you with the inverted yield curve is that we're not in the beginning of a multi-year bull cycle, that there are severe economic disruptions reflected in the inverted yield curve. Now, you can go back test that. There's no scenario where an inverted yield curve didn't lead to some type of economic bust, economic downturn. Now, some people may be saying that this time is different, but it's not, or probably not. So ultimately, I'm calling for interest rates to go down to historic lows. Again, it won't happen immediately, but if that were to happen, you buy a long duration bond fund like TLT, BlackRock's TLT, which is 20-year maturity and greater in bonds. Of course, for those who may not be this in touch with the bond market, the underlying value of the bond trades inversely proportional to the yields. So if yields fall towards zero, the value of TLT, or these long duration bonds, will increase. And I think during that period, you might see TLT rise up, at the very least to 134, but it might reach up to 150, even create new highs. Who knows? But I do think that yields have bottomed out, yields have topped out, and therefore the value of long duration bonds have bottomed out here. And you can kind of see this bottom formation forming right here, where you've got this lower low on high volume, and then you see that volume climax right there, and then volume starting to lower down from that climax, and you just need to reclaim the neckline right here. So what does that mean for Bitcoin, right? Let's go to the great old Bitcoin chart. What this means for Bitcoin is that relative to other historic Bitcoin cycles, that this one will behave differently. So we've kind of already seen Bitcoin go parabolic into the halving, right? So we can mark off the halving here. I know it wasn't exactly April 20th, but almost on 420. So we'll mark it off right there. You saw Bitcoin go parabolic into the halving and create new all-time highs prior to the halving, which has never happened before. So what that should tell you is that we're this cycle is premature relative to other cycles. And so I think a lot of people will be comparing this cycle to the 2017 cycle, but I think it's actually best to compare it to the 2013 cycle, where you had a major correction in the middle of the cycle. So you got an 80% correction in the you got your halving down here in November, and then 5 months Bitcoin went parabolic and then corrected 80%, but that wasn't the end of the cycle. The cycle went much higher after that. And personally, I think that's what we're going to see in the current cycle, just based off how far along the parabola the Bitcoin is currently, and how premature this cycle is. Let's go back to current price action, but and also based on what I'm forecasting for equities market, I can't leave that out. That's certainly factoring into the way I'm looking at Bitcoin. Is I'm looking for equities to top out kind of in the October, early Q4 timeframe. And, because Bitcoin, a lot of the capital moving through Bitcoin is moving through the Bitcoin spot ETF. It's very tightly correlated to the spot Bitcoin ETF market. So, it has a very strong correlation currently to traditional markets. So if you think that traditional markets will have a major sell-off at a certain point in time, then that's going to affect Bitcoin, and Bitcoin's going to sell off too, because a lot of these institutional players, they own Bitcoin as part of their portfolio. They have other assets, and if their other assets start selling off dramatically, Bitcoin is not in isolation anymore, right? A lot of those institutions will need to sell down their Bitcoin to generate liquidity to pay their expenses and pay their liabilities. I wish Bitcoin was not tethered to the traditional markets, but that's the unfortunate reality of what Bitcoin ETFs have done. Create a lot of demand, but also created a tight correlation to the traditional markets, unfortunately. So part of what I'm calling for is kind of a decline in the dollar currency index. I think this is a very important point that I don't think I've mentioned yet, but for those who are following geopolitical news, you may have seen that the financial authorities in the U.S. and Japan met to address a weakening yen and a currency crisis in Japan. And part of that means bailing out the country of Japan. So it's interesting how this didn't really get primetime news, but the country of Japan effectively got bailed out, at least their financial markets. And so what does that mean? That means that the amount of dollars in circulation is increasing dramatically, just not in the U.S., right? Because the U.S. is still, the Fed is still trying to fight inflation domestically. So they're, not increasing the amount of dollars in circulation within the U.S., right, to try to curb domestic inflation. But, they're bailing out foreign countries and increasing dollar liquidity globally. And those people, can use those dollars to buy U.S. stocks. And a lot of them do. I mean, that's the U.S. Stock market is the financial hub of the world. And so a lot of those dollars that are, being created globally are being used to buy U.S. stocks. It's just the reality of the situation. And because of that, and because I think, and ultimately, the dollar chases yields. So at the end of the day, if you're predicting that yields in the bond market are going to go down, the dollar is going to go down because the dollar just follows yields. And that, that's what I'm looking for, is yields to sort of collapse towards zero. And, if you're a millennial or Gen Z listening, that means a major opportunity for you in the future, if I'm right, to purchase a home, or at least get a mortgage on a home that has a favorable cost of financing. And something to keep an eye on. I think people just get caught up in the trend and the momentum. For the last few years, we've just seen interest rates going up. So people, just psychology is that they just think that interest rates are going to continue to go up. They don't understand the leads and lags in the market. And I do understand that I probably haven't fleshed out my thesis for why interest rates, will decline that dramatically well enough. But, really it boils down to the idea that the financial markets are very over leveraged. And if you look at the leverage in the system compared to where it was in 2008, leverage is far greater. Maybe not in the U.S. because there's a lot of stricter regulations, but if you just look at like the global financial markets, there's a lot more leverage. So everything is more sensitive to interest rates. And I think that the lag effects of tightening, not just from the Federal Reserve, but what other central banks have done, have not manifested themselves yet, and will manifest themselves at some point in the future. So anyway, the one market that's important that I did not touch on was oil. A lot of people are bullish on oil. I'm actually pretty bearish on oil, just because of course the value of oil is the lifeblood of the economy. If you watch the Dune movies, it's basically the spice, right? If you watch Dune, you know what spice means in the reference to the most valuable resource in the universe. Well, in our universe, or at least on Earth, the most valuable resource is oil, and it's the lifeblood of the economy. It's very understandable why someone would have a bullish narrative on it. I just think that people don't necessarily understand that if the credit markets contract, then demand for oil will decrease very short term dramatically, like what you saw during COVID, where oil futures went negative, right? You can have that type of disruption in the oil market. Again, it doesn't make sense, right? There's no reason why oil should essentially be free for brief periods of time. But that's the kind of disruption that over-leveraged and disrupted credit markets can cause. And if that type of situation unfolds, I'm pretty bearish on oil, and I think you will see. Maybe not as crazy as it was when the whole world shut down due to COVID, but I do think you'll see new lows, especially if you see that type of economic bust scenario that I'm predicting to unfold. And an economic bust essentially it'll feel like a depression, right? It'll feel like the world is ending, but it won't last as long as a depression because of the response that central banks will have when they, when things are unwinding. They will step in and they will unload, unlimited money, right? Whatever they need to do, right? There's literally no limit to the amount of money they can create. So they will create as much money as they need to. If they need to create if the Fed needs to print $20 trillion to fix the system, they'll print $20 trillion. If they need to print 30 trillion, they'll print 30 trillion. There's no limit to it. So that's sort of the reason why it will be a protracted depression. But, on the other hand, right now the Fed is still talking about inflation. So they're not in a position to start printing money because they know that will increase inflation, and they're still talking about inflation. They're not going to start doing that until things really start collapsing. And I think that the Fed will kind of drag their feet and not act as quickly as they should because they're still talking about inflation. And that could have, implications that not necessarily make the bust/depression longer, but it just make it more severe, right? There'll be a period, I'm predicting a period of inaction where the Fed fails to act quickly, and then they start shitting their pants and print, because if they're faced with the possibility of the entire global financial system imploding or a theoretical rise in inflation of 3 or 4%, it's very clear that they're going to choose to save the financial system at that point. So what does that mean for Bitcoin? I think 100,000 is a very key psychological level. I think as you see equities start to make new highs, you'll see Bitcoin start to reach for the 100,000 level. Does it overshoot it? I mean, I have no idea, but there's really no good way to call a top like that, because parabolics can get extremely out of control. So there's no honor in calling tops, but there is some value in having a little bit of discretion and knowing when to be defensive, right? So I think if you see a parabola start to take out 100,000, later into Q3, Q4, the equity markets are going parabolic. Things are starting to top out. Maybe Bitcoin's up at 120,000, 130,000. You're getting kind of around that October 2024 time. The narrative shifting bullish. All the bearish narratives that still, there are a lot of bearish fundamentals still in the market that, you could talk about, but people won't be talking about it at that point. That's the time to be cautious and to exercise restraint. And I think the way personally that I would do that, I have full disclosure, my biggest positions are in Bitcoin, MicroStrategy, and the Bitcoin miners. So very Bitcoin focused portfolio. I would be, in that phase of the market, at what I believe to be the top of a parabolic blow off, I'd probably be buying put options to cover my underlying. And that would be the way I would be hedging it and trying to defer some of the tax obligation, to buy puts with a strike, a 2024 strike, or a 2025 strike, or not strike, an expiration. That'd be the way I'd play it. Not financial advice. Hope you guys found some value in this video. Subscribe if you haven't already, and I'll catch you guys later.